Ladies and gentlemen, good day and welcome to Q2 and H1 FY21 earnings conference call of Chalet Hotels Limited. We have with us today from the management, Mr. Sanjay Sethi, Managing Director and CEO, and Mr. Milind Wadekar, Vice President Finance and Tax, who is also the interim CFO. As a reminder, all participants' lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note this conference is being recorded. I now hand the conference over to Mr. Sanjay Sethi, Managing Director and CEO. Thank you, and over to you, sir.
Thank you so much. Good morning, everyone, and thank you for joining our quarterly earnings call for Q2 of FY21. I do sincerely hope that you and your dear ones are safe and in good health. Well, it's been 9 months since the lockdown, and this is the third time that we are addressing you since the pandemic. The crisis has clearly impacted the world a lot harder and a lot longer than earlier anticipated. The news updates on vaccines being developed with the assurance of a cure in the next couple of quarters are encouraging and give us some sense of a time frame for normalcy to return, with the potential ability to significantly accelerate business recovery next year. Another positive indicator is the progressive decrease in number of daily reported cases and mortality rates, especially in the cities that we operate in, and we do hope these numbers will dip further. We believe the worst is behind us. However, we stay vigilant, and there is no relaxation on the health protocols at our end. Since our last interaction, India has entered into air bubble agreements in 19 countries now, which has generated some international air traffic, even as the Vande Bharat flights continue to operate. Quarantine restrictions have also been relaxed in most cities. All our hotels have been in operation since August of 2020, and with various restrictions across the states being lifted, we are making baby steps on a weekly basis towards recovery. In addition to Bangalore and Hyderabad, Maharashtra government issued new guidelines allowing dine-in options for non-resident guests for food and beverage in October. The response has been very encouraging, including continued traction for food delivery and takeaways. I've also worked with the rest of the executive committees of trade bodies like CII Tourism, Hotel Association of India, and HRAWI to push for relief for our industry. I'm happy to report that we've had some significant success, especially in the state of Maharashtra, on the following aspects. You would have heard that the property tax relief has been extended to hotels that were used for doctor's stay for 3 months by the municipal corporation, and the 2 big hotels of ours in Mumbai will get that benefit. We are pressing for a 6-month relief on this. Similarly, industry benefits. We were declared as an industry in 1999 in the state of Maharashtra. We didn't get the industry benefits on tariff for electricity, water, property tax, etc. This has now been announced that we will get those benefits starting 1st April 2021 in Mumbai, in our Mumbai hotels as well as in the Pune hotel. We are indeed grateful to the state government for this landmark breakthrough on a long-sought industry ask. Opening out of restaurants, bars, and banquet for non-resident guests was a push through the local bodies, and I think we've been successful in that and now have significant opening up of F&B in hotels. There's also been significant reduction in state licenses and approvals in Maharashtra. I don't know how many of you got that, but the Maharashtra government has reduced 70 licenses to build a hotel down to 10 now, plus 7 self-certification. And another important thing is that these licenses will come with a 5-year validity. Another commendable job by the state government on ease of doing business. On the operating front, our portfolio ADR compared to Q1 of this year has sequentially grown by 4% in Q2 to 4,030 rupees, whilst the occupancy has risen by 100 bips to 25% for the same period. I must highlight here that during the quarter 1, we had a significant inflow of Vande Bharat and doctor stays that started ebbing off sometime in late August, early September. So September actually fell. July and early part of August, the occupancies were significantly higher. And that fall is now being replaced by more sustainable forms of segments. Compared to the previous year for the same quarter, the ADR is down by 48%. Occupancy contracted, as I said, to 25%. Last year for the same period, we were at 74%. Talking about this. Give me a moment, please. With the change of the mix, our ADR for September was higher by 8% as compared to August. October also saw an uptick in occupancies to 26% sequentially and a resultant RevPAR improvement of 28%. All our properties have excellent staycation and workation offers and are getting strong traction. We've continued to focus on tapping all business opportunities, including new revenue-generating segments and special purpose groups like Seafarers Group, Cargo Airlines, airline crew, BCP rooms, and continue to explore more. Our operating partners have made significant inroads in garnering business of project-based travel from domestic and multinational companies, and we see these converting to occupancy build-up in the current quarter. On the cost front, we've executed the centralization of finance function for the 5 Marriott managed properties at Chalet. That team now will sit out of Mumbai and manage all the hotels with significant reduction in number of people. We are working towards centralizing the human function. We've also centralized laundry for our Mumbai hotels and are exploring outsourcing laundry for Pune. We continue to optimize our employee productivity while benchmarking ourselves with the global best. As of September 30th, our hotels operated at a staff-to-room ratio of 0.75 per room. This was, I might remind you, our target about 9 months back to get to this target, as compared to 1.17 per room in February of this year. Consequently, the payroll cost has come down by 42% for H1 this year compared to H1 last year. And by the end of October, the employee productivity ratio has further improved to 0.73 employees per room. All these initiatives, centralizing and outsourcing of operations, employee right sizing, energy conservation, along with other initiatives, have resulted in rationalizing fixed costs, which will be value accretive for the company P&L in the long run. The adoption of increased technology in the hospitality segment is expected to offer our guests the option of reduced human interface, a significant step in the new normal. Few areas that we are actively working on include keyless mobile room access, digital check-in, check-out, using handheld devices, contactless service by digitizing our room directory, touchless attendance systems for employees, e-menus, e-ordering with integrated digital payments, to name a few. We aim to have the keyless option, which is basically guests using their mobile phones for everything, in place for 100% of our hotels by end of the current financial year. Rentals for our commercial portfolio continue to be unaffected and support our cash flows. Retail operations have commenced in both Mumbai and Bangalore, albeit at a cautious pace. On the positive side, the footfalls are picking up in Bangalore for the festive season, and spends per footfall have also been higher. The retail and commercial segment have contributed roughly 169 million in Q2 and 342 million rupees in the first half of the year to EBITDA of the company. I'm happy to share that as in Q1, we've managed to stay in the black at EBITDA level for Q2 with consolidated EBITDA at 30 million rupees, largely powered by the strategic mix of the asset portfolio and a very diligent effort towards cost management. A quick update on the project pipeline. In the current VUCA environment, it is critical to think and analyze on the go and form a strategic direction for the short and midterm. Keeping this in mind, the company has been evaluating market dynamics for our project pipeline, and we have decided to recommence construction at 2 of our commercial development sites. We have already started work at the commercial tower of 750,000 square foot of leasable space at the Pavalex, and we will shortly start work at the Bangalore Whitefield location for the commercial tower, which is roughly around 450,000 square foot of leasable space. That's a combination of multiplex and office. Our market assessment indicates strong demand for new Grade A office space in these locations over the next 12 to 30 months. Both projects are part of our well-defined hotel-led mixed-use asset development strategy. In the current market conditions, the commercial segment has proven to be resilient and a good cash flow hedge for the company. The lobby renovation underway at Renaissance is on track and will be completed by end of this calendar year. We will evaluate the start of balance renovation work at this hotel on an ongoing basis to right time the brand upgrade. Our current estimate to commence operations in the new hotel in Hyderabad is beginning of Q3 of next year, which will require us to restart work on site by Q1 of next year, probably April of next year. We will review this decision basis demand dynamics in February again before we kickstart this work. Similarly, the need for commissioning additional 88 rooms in the hotel will be reviewed on an ongoing basis. However, the two proposed hotels, one the W at Powai and Hyatt at Airoli, Navi Mumbai, where the work had not started as yet, they have been put on hold till we have more clarity on pace of demand before we commit capital to these projects. I cannot end without thanking my team at the hotels, retail assets, office assets, and at the corporate office, who've done a tremendous job of coping in very trying circumstances and coming out with flying colors. I'm pleased to share that we now have 6 young and dynamic lady colleagues out of our 11-member senior management at Chalet Hotels, in line with our gender diversity focus. This leadership team will now work towards driving the diversity ratios at all levels of the company. We are further encouraged by being listed as one among India's best workplaces for women in 2020. Similarly, the next few months, we are going to focus our efforts on additional areas of ESG, like a path and timeline to being carbon neutral, and work on other initiatives also. We've utilized our time well in the last 8 to 9 months. We will continue to do so and make sure we come out as one of the leading companies on our integrated reporting front. Now, allow me to introduce our interim CFO, Milind Wadekar. Some of you have already interacted with him. He's been with Chalet Hotels for over a decade now and has played an instrumental role in its success, handling the finance function as the Vice President for Finance and Accounts. Over to you, Milind.
Thank you, Sanjay. Good morning, ladies and gentlemen. I hope everyone is staying healthy and safe. Our presentation has been uploaded on the stock exchange and made available on our website. I hope you had a chance to go through the same. As mentioned by Sanjay, the current pandemic is taking longer than anyone had anticipated. Our focus continues to be gradually scaling up operations while managing cash flows and controlling cost. The performance comparison with the same period last year would not be justified given the current scenario. Hence, we would be highlighting our performance sequentially with the first quarter of the current year. For the quarter ended September 2020, the total income was at 641 million as compared to 2405 million in the same quarter of previous year. On sequential basis, compared to Q1 FY21, total income grew by 9%. As elaborated by Sanjay, the company continues to work on its cost structure. The total expenses were lower by 60% during the quarter as compared to Q2 FY20 and were marginally up on sequential basis as we operationalize all our properties and scaled up services. As highlighted in slide 14, our fixed cost continues to be rationalized, which is likely to have longer-term benefit to the company. Resultantly, the EBITDA was at 30 million as compared to 3 million in Q1 of the current year. For the period of Q2 FY20, our EBITDA was at 867 million. For the first half of the year, total income was at 1,231 million. Total expenses for the period were 1198 million, a drop of 62% from the previous year's same period. EBITDA was at 33 million for half year. Hospitality segment accounted for 56% of the revenue at 359 million in Q2 FY21, a sequential growth of 15% over Q1 of the same year. In Q2 of the previous year, our revenue was at 2,046 million. Within the hospitality segment, Room revenue accounted for 66%, F&B accounted for 26%, and 8% was from other services. The segmental loss before interest, depreciation, and tax was at 107 million as compared to 145 million in Q1 of this year. On the cost front, power, light and fuel and payroll cost, which are traditionally majorly fixed in nature for our business, have been lower by 62% and 48% respectively in Q2 FY21 as compared to previous year. Even sequentially compared to Q1 of this year, power, light, fuel costs have been lower by 7% and payroll has been lower by 17% as we continue to work on improving our cost structures, benchmarking with global standards without compromising guest experience. For the first half, revenue was at 673 million as compared to 4,244 million in the same period last year. The segmental loss before interest, depreciation and tax was at 251 million as compared to profit of 1,602 million in the same period of last year. The mixed-use development under retail and commercial segment continues to show resilience. Commercial segment has seen steady receipt of rental revenue, while retail has shown signs of pickup in the last quarter. The revenue for the quarter were at 229 million as compared to 213 million in the preceding quarter, same year, in the year FY21. Adjusted for SLM, the revenue grew from 176 million to 192 million as retail for the same period. For the half year, this segment had revenue of 442 million and EBITDA of 342 million. On treasury fund front, we have sequentially reduced cost of debt to 8.74% as compared to 9.38% as of March 2020. Our gross debt stands at 1,802 crores as against 1,791 crore as on March 20. Our net debt has increased to rupees 1,757 crores as compared to 1,657 crores at March 20, an increase of 100 crores. This is taking into consideration capex spend of 34 crores in the first half of the financial year. Our cash burn, that is EBITDA less finance cost and repayment of term loans for Q2 and H1 have been at rupees 85 crores and 172 crores respectively. This clearly signifies prudent cash flow and working capital management. As of today, we have 195 crore undrawn lines of credit for general corporate purpose and liquidity of around 45 crores. We have recommenced construction work of commercial project at Powai and shortly expected to commence work on our Bangalore port project. The estimated return on investment the estimated ROI on incremental investment shall be in high teens. The promoters have continued to subscribe to 0% non-convertible redeemable preference share for funding the outflow relating to residential project at Koramangala, and the redemption is contingent on surplus from the project. The total value of subscription is 1,250 million as of today. With this, we now open the floor to questions.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. We will wait for a moment while the question queue assembles. To ask a question, please press star 1. We have a first question from the line of Aditya Bagul from Axis Capital. Please go ahead.
Hi, gentlemen. Good morning. Thank you for taking my question. So I have three questions. First question is essentially on our mix when it comes to the losses in the hospitality segment. I am referring to slide number 12. What I see is that Bangalore Marriott is now at break even. So I just wanted to understand what is it that we're doing so well when the losses in Bangalore Marriott are close to negligible, or actually it's a slight positive as well. So that's question number one. The question number two, Milan sir, is to you. Can you just explain a little more in terms of this EBITDA cash burn? I think I missed out some of those numbers. You said 172 crores. But if you can highlight a little more. And in the same breath, if you can advise us what is the kind of principal repayments that we've got stacked up towards S2 of this year and full year of FY22.
Thank you, Aditya. This is Sanjay here. Let me address the first question of yours. On the Bangalore side, we have the benefit of a long-term contract with Accenture on the learning center. So the 67 rooms there are occupied by them on a perpetual basis for a 7-year period. We also have some public areas leased out to them. And I think the team has done a fabulous job on the cost management side. In fact, if you were to look at the various cities and the numbers in terms of operating performance, overall, Bangalore is probably the worst performing city in the country today. And I think we felt that impact with regular sustainable business at our Whitefield Hotel also. But the combination of the Accenture Learning Center and the cost management has helped us scale through. We've also had significant success on food and beverage there. Bangalore and Hyderabad, as you probably know, opened out their F&B to non-residents almost about 3 or 4 months back. And the benefit of that has been that our Sunday brunches, our dine-in ops, our bar sales, and very importantly, delivery sales. They're all a big part of the F&B increase that we're having. We're similarly seeing similar trends in Hyderabad. In fact, Hyderabad in the last 6 weeks or so, F&B has been going through the roof over there. We were there in Hyderabad on Thursday and Friday last week, and the restaurant was packed. There were people waiting to get into the restaurant and eat for a Friday lunch. Similarly, our bar over there on the rooftop is doing extremely well, and our Sunday brunches are doing very well. Just to give you an example, Diwali hampers become a key part of revenues at this time of the year. We expect to hit almost about 50 lakhs of revenue from Hyderabad alone, from Diwali hampers alone. So Hyderabad is a mixed bag of ALC and cost management. The regular occupancy is still to be picked up. As it picks up, I think our numbers will start looking rapidly better. Milan, do you want to come in on the EBITDA part?
Aditya, our cash burn for Q2 was 85 crores, and for half year was 172 crores. Our EBITDA for half year is 33 million, that is 3.3 crore. Our interest debit for half year is around 80 crore rupees, and repayment was 95 crore rupees. That's how it adds up to 172 crore rupees cash burn for H1. Now for H2, we have repayment obligations of around 85 crores, and our finance cost we expect to be in the same range.
To be around 80 crores.
Yeah.
Okay. And Milan sir, if you can advise us, what is the number likely to be in terms of principal repayment for FY22?
FY22, it will be around 240 crore rupees also.
240 crores. Okay. Okay. So apart
I think, Aditya, it's important to highlight that we do have conversations in play to make sure that we don't have a cash flow challenge at all in the foreseeable or midterm future.
So, Aditya, as we have mentioned, we have undrawn lines of credit of around 195 crore rupees as of today. and we have cash on hand of around 45 crore rupees. So we are very comfortable with our cash position for short term as well as medium term.
Sure. That makes a lot of sense. One last question, Sanjay, to you is I mean, it shows a lot of conviction on our part that we've resumed some of our commercial construction activities once again. So just wanted to understand from you, how is the response from WPP and Accenture, which customers who house our commercial property. So what have they got to say about this, and how does that link into our manufacturing construction pipeline growth?
So I think that both these companies are large companies. They're not going to take knee-jerk reaction by a couple of quarters or 2-3 quarters of lockdown. We've had rentals coming in on time for both the companies for 6 months. We had given some relief on parking charges and CAM charges, but then that was because on CAM we reduced our costs. So we passed on that cost saving to WPP. And similarly now we might pass on some savings that we've been able to do to Accenture on their end. But yeah, we haven't had a challenge we're getting our rents on time. Relationship is strong, and the reason for starting the 2 projects is that the markets seem to be ripe with the timing that we have in mind. We're looking at roughly around 20 months for the Powai project and less than that for Bangalore. And the demand for new grade A office spaces of good quality in both locations is very high.
Right. All right. Perfect. That answers most of my questions. Thank you so much, and wish you all the best.
Thank you, Aditya.
Thank you. We have next question from the line of Amandeep Singh from Its Capital. Please go ahead.
So thanks for the opportunity. So sir, your investor presentation talks about significant increase in domestic contract negotiations. So can you help us understand the customer profile like SMEs or even large corporates, the micro markets and the areas for these contracts?
So Amandeep, I may not be able to give you the areas. Let me break it up into 2 sections. One is the RFP accounts, which are global accounts. On the RFP accounts, we've done a rollover of 2020 rates into 21. So, and all our RFP accounts have accepted them, and they said when we start travel, we'll come back to your hotels at the same rate as 2020. So we don't see a challenge or contraction of rates from the RFP global accounts. On the area that we didn't have too much of traction in the past, it was there but not so strong, was in the local company, domestic companies. And that's where the last 9 months have been spent in building relationships and tying up what we call LNR or locally negotiated rates with these domestic companies. These accounts will probably come at a slightly lower rate than the RFP accounts. And that's okay. Right now, our focus is to make sure that we fill up our rooms and get the business running and picking up momentum there. So with that in mind, I think we'll have a strong traction of the domestic accounts to begin with for the next couple of quarters before large-scale international travel really starts on the business travel side. We've also, but not all is lost. I mean, I was quite surprised myself when I look at the numbers. 19% of our guests in our hotels in the last quarter are still foreigners. And most people thought that they have vanished. That's not the absolute case. And therefore, we are confident this will come back at some point of time.
Sure, sir. That's helpful. So my next question is related to Hyderabad micro market. So why the city witnessed amongst the highest grade A office space absorption in the recent quarters? We note that the hotel occupancy in 2Q was low at 9% for Western Hyderabad. So sir, in that context, can you help us understand, is it due to COVID-led near-term headwinds or there has been some structural change in the outlook for the micro market?
No, I don't think there's any structural change. It is driven by COVID, and I think once the travel restarts, we'll be back to normal. What had happened in Hyderabad is in Q1, we had a lot of BCP groups, business continuity plan that two companies had rolled out. I think Qualcomm and Bank of America were the two companies that stayed with us. And they gave us business for almost about 8 weeks. And therefore, you see a sharp drop in Q2, which they weren't there for Q2. Hyderabad started picking up. I'm happy to report that in October, I think we hit 15-16% occupancies. November looks closer to 20%. So clearly, it's ramping up very rapidly now. The good part of Hyderabad is that whilst the foreign IT business traffic has still not started, we see project-based movement, we see wedding groups, and we see a lot of staycations there. As I mentioned earlier, we were in Hyderabad and we saw, the amount of activity in our restaurants quite phenomenal. I mean, the team had to actually fight off guests to maintain social distancing and make sure that we don't occupy more tables than are practical and safe. So therefore, there were people waiting in the lobby. And that's happening at our bar too in the evenings over there. We have an outdoor bar called Kasbah. Does extremely well.
So that was really helpful. And so you highlighted about reason of capex plans across commercial portfolio. So in that context, can you help us understand the capex outflow you are expecting for the same in FY21 and 22? And will it be fair to assume this would be via fresh debt?
Sanjay,
I will let Milind answer that. Go ahead, Milind.
Our estimated capex for H2 will be somewhere in the range of 115 crore. This will be primarily for commercial project. And for next year, our capex will be in the range of 550 crores or so, which includes some capex for hospitality projects. That is our Hyderabad project as well as rebranding of Renaissance Hotel. So that will be revisited as we progress based on outlook of the business.
But Milind, maybe you want to add what is going to be a source of this capital?
Yes, we have tied up funds, loans, and we are tying up for additional loan of around 600 crore rupees, 650 crore rupees for commercial projects.
And that combined with the principal paybacks will not take the overall debt to worrying levels.
Yeah.
Sure, sir. That was helpful. And so lastly, on retail, while you mentioned improving trends across the portfolio, will it be possible to quantify how would be the footfalls and consumption trends versus pre-COVID levels?
I don't have that number with me. Milind, do you have something? And unfortunately, we're sitting in two different locations. Milind, do you have numbers?
So footfall and business transacted is at 20 to 25% as compared to pre-COVID level.
Sure, sir. That's all from my side. Thank you and all the very best.
Thanks, Amandeep.
Thank you.
Thank you. We have next question from the line of Nimish Patil from Ascapedia. Please go ahead.
Hi, good morning. Thank you for taking my question. Actually, I'm an independent investor. I have two questions. First is, when does the management expect the average revenue per room to return to pre-COVID levels? And my second question is, considering the recent reforms by the government of India in the travel and tourism sector, how does Chalet Hotel, how would that benefit Chalet Hotel in the long run? Maybe I heard something about the moratorium restructuring for travel and tourism, or I'm not quite sure about other reforms, but how do the government policies impact Chalet Hotel?
Sure.
Two questions.
So, Nimish, I'll answer your first question, then go to this, the benefits part. On the RevPAR front, I think to hit 2019 numbers, and I'm looking at calendar year 19, we are likely to go to calendar year 22, or maybe overlap a little bit into calendar year 23 to really get back to this RevPAR numbers, that is a blend of occupancies and ADRs. So FY23, in my view, especially the second half, should be very, very close to FY20 numbers in the second half. On your second question, there are various types of reliefs that have been given. One is the fiscal reliefs that have been given a combination between the finance ministry, the RBI, and the banks. On that front, whilst we studied the moratorium and the restructuring opportunities, we never needed to look at them because we were very comfortable on our balance sheet front. So we did not take the moratorium. We have no intention of restructuring our debt. We are well placed as things stand. There are other reliefs that have been announced by the government, which include things like industry status, industry benefit on electricity tariff. That's the second largest cost in our operating cost in our business. Property tax reliefs. All of that's happened is most welcome, and obviously Chalet gets to benefit extensively from it, given that 60% of the portfolio for us, almost 2/3 actually, is in Maharashtra. So between Pune and Mumbai, and the only state in the country to give industrial tariff on these things, we do look forward to this initiative by the government and welcome it.
Awesome. Thank you very much. I appreciate it.
Thank you. We have next question from the line of Sumant Kumar from Motilal Oswal. Please go ahead.
Yeah. Hi, sir. So we have seen the improvement in October in occupancy side also and ADR. So can you discuss about the forward booking? How is the demand for your upcoming November and December month?
So Sumant, this whole pandemic period has been extremely volatile, and it's been very difficult to forecast whilst the pandemic is still going on. The period of kick-in, we call it kick-in, and pace of bookings has shortened significantly. Just to give you an example, we recently picked up some 5,000 rooms in 24 hours for one of our hotels. So in 1 month. And our occupancy is double for that month for that hotel. But those are sort of things that happen because this is all largely ad hoc group and large movements of groups type of business. I can tell you the segments that are bringing in a lot of these large groups. One is the seafarers, because we still see maritime employees going up and down in and out of India on a regular basis. Second is the Vande Bharat flights still continue to come in and out. Third is the shooting units. We see a significant amount of activity happening on that. And finally, and that's the more recent one, we see a lot of companies getting back to rehiring and moving people for training purposes in large volumes. And from a safety perspective, staying at a 5-star hotel makes the best sense for them to ensure that they are not, there's no health risk to any of their new joinees, and nor are they in any risk of being sued by anyone. So from all that perspective, we see good traction happening. And finally, I think the staycation part has been a solid sort of source of room bookings in our hotels in Pune, Hyderabad, and Sahar, the JW Marriott Sahar. We see some traction happening at Powai also now.
So what percentage of demand, rough cut, is staycation currently?
So right now, it's mostly non-traditional demand. The more traditional demand of business traveler coming in for short stays and going out with higher rates, I think is about a month or so away when the domestic kick-in will start. And then that will be followed by international travelers doing the same. However, long stay project-based business has already kicked in fairly well. So we've heard of companies like Samsung, Apple, and all of them moving into towns and IKEA and taking up extensive rooms. We see that happening at our 4-point Sheraton Vashi. See, the other thing is that we have very large box hotels in most cases. Now, the Vashi Hotel, which is 150 rooms, which is typically the size of Indian 5-star hotels in the country, is already clocking about 45-46% occupancies. So that's the difference in your large boxes. Whilst during these times, you may see occupancy percentages small, but the ability to bring down your costs combined with potential ramp up very quickly when things normalize create a great future for in the mid and long term.
How is the wedding inquiries?
Several, surprisingly several. The only problem is that there's still restrictions on number of people that you can have. So therefore, they are small in size. Right now, the restriction is 100 people. In Maharashtra, it's still 50. We're hoping that'll go up to 100. But on a case-to-case basis, between the hotel and the wedding organizers, we do apply for larger approvals. And in some cases, we've been successful in getting increasing those sizes to 150 and 200 also.
So that is also comparatively compared to previous year, the demand of wedding is very strong for the coming couple of quarters.
Yes, number of events are far higher. Our number of people per event is lower. But what we are doing is we have a minimum guarantee format in play in some of the key hotels that we have. So in terms of revenue, we have some form of protection on the downside, against the downside rather.
So that is giving overall the clarity on the expectation of revenue, whatever we have in Q2 is going to be far better in Q3 and Q4.
Yes, in fact, we've had some weddings in Q2 also. I must share that with you. But we expect that this will go up further in the subsequent quarters.
Okay.
I can't really give out numbers at this stage, but.
Okay. What's your view on corporate traveling in Q3, Q4, or maybe what's your view on that?
So some amount of
large corporate
travel. Yeah, some amount of domestic corporate travel has started. We see that happening in some of our hotels, but it is not large. I was expecting that we'll have a larger kick-in post-Diwali. Let's see how that pans out. But I think from January onwards, for sure, there should be some distraction on corporate travel. And the quarter after that for international travelers.
Say Q4 onwards, you're talking about the international travel?
No, international travel will be Q1 of next year.
Okay. Thank you so much.
Thank you. A reminder to participants to ask a question, please press star followed by 1 on your touchtone phone now. We have next question from the line of Venkat Samala from Tata Asset Management. Please go ahead.
Hi, thanks for taking my question. Sir, if you could just highlight how the mix has changed from the COVID-centric segments like quarantine, doctors, medical staff, some of the institutional quarantine, etc., to the more regular demand, say from the start of Q2 to October maybe, if that's possible.
So it's difficult for me to sort of give you an exact number of how it's changing, because it changes as a mix every month. So for example, right up to August, early August at least, we had a lot of doctors staying with us. We had a lot of Vande Bharat people staying with us.
Right.
And then we had seafarers come in and out, then stop, and then again start again. So it's been a bit erratic, and therefore you see the variation in the occupancies. But I'll give you a reference point, right? The quarantine business or repack business in September for the portfolio, for example, was 1,200. It dropped in October to 383. But the project-based corporate business, which is 537, grew to 2,400 in October. Similarly, the retail business booked online, which was 1,235 rooms in September, jumped to 5,719 rooms in October. So we're seeing a lot of fluctuation happen. The good part is that in October, the movement towards project-based business, retail business, and a couple of other things like crew are actually positive because they indicate more sustainable segments.
Right. Sir, and if you could also highlight what are the rates at which these more regular sort of, or the segments that you think are not are more sustainable would be coming at, because the ADRs have not changed materially Q on Q, right? So that's the reason I'm asking. So how could the ADRs move year on when the demand moves towards these normalized or sustainable segments?
So, Venkat, that's going to happen only when the normal business starts coming in. Till then, most of the business that we pick up is going to be ad hoc in nature and will be negotiated across the table. And depending on how the need is for getting that bulk of business in that particular hotel, rates will be negotiated. So it's very difficult to put a number on it. Good part is that from an average of about 3,000 rupees, we've now crossed the 4,000 mark. At that pace, we should continue to grow on a fairly strong basis from here onwards. We were also dragged down largely by the doctors' rooms at Renaissance for several months. That's gone. We've replaced it with a large shooting unit which is staying with us for a month, but again at discounted rates. But it brings in a serious amount of revenue, both F&B, lawn rental, 100 rooms for 30 days. All of that helps.
Right. So if we were to do a more like for like comparison, at least, because we have some transparency or some reference point, at least for retail when we are selling through these OTAs. So if we compare to say last October or November, what would the rates be?
So, see, the overall rates, as we mentioned, have dropped from 7,800 last year, same quarter, to 4,030 rupees, right? On a segment-wise basis, because these are all ad hoc segments, therefore each of them is negotiated on a very individual basis. And I'm not able to give you a segment-wise rate because the segments are new, and there's no comparison from the past year for these segments.
Right. So, I completely get it because the mix has also changed and now the focus is more towards, improvement of RevPAR. But what I'm trying to understand is that the rates on a likewise basis have also come off, for us and for the industry as a whole?
So quarter 1 to quarter 2, yes, we've seen that increase happen. And on a weekly basis, we see traction happening on rate movement northwards.
Right. So at least here on, it has ebbed and there will be sequential improvement from here, right? The direction will only be northward.
We see that happening, yes.
Right. Sure. And also slightly more long-term perspective of, what sort of savings can we have from the industry status which is being given to the hospitality segment for us, for the hospitality industry.
Let me give you a reference point here. In Maharashtra, electricity rates for commercial establishment, that is what we are paying, are in the range of about 14.5 rupees. We had done third-party power agreements and were able to bring it down to about 10.5, 11 rupees through the mix of third-party power versus state electricity board. But the state electricity board power in future will come at 7.5 rupees.
Right.
So therefore, that 14.5 comes down to 7.5. And then you blend that with third-party power purchaser. We are hoping with the removal of electricity duty or reduction in electricity duty, that rate will also come down. So we expect a significant drop in our power tariff. Similarly, water will be paying lower charges, but more importantly, property tax, which is a significant part of our fixed costs, will also come down. Just to give you a reference here, property tax for lowest is residential, followed by industry, followed by commercial, both office and shops. Shops, I think, is higher than the office, or the other way around. And hotels was at the top end. Now, hotels come down 3 levels below to industry.
Okay.
So there'll be some amount of saving. This is only for our Maharashtra hotels.
Sanjay, let me come in. Venkat, to give you reference, electricity duty for commercial establishment is 21%, which works out to around 3 rupees per unit. And it will be reduced now to 9%. So that itself will give us per unit reduction of more than 1 rupee 50 paisa.
Right.
Plus, industry tariffs are lower.
Right. So as I understand, at least for these two heads, property tax and the power expenditure, just for the Maharashtra properties, you could save 15-20%. Is that a fair assumption to make?
Yes, it could be little higher than that. Since we had very effective open access arrangement, saving will be in the range of 15-20% for us.
Right. Sure. Thank you. Thanks a lot and wish you a very happy Diwali.
Thank you.
Happy Diwali to you too.
Thank you.
Thank you. A reminder to participants to ask a question, please press star followed by 1 on your touchtone phone now. We We have next question from the line of Amit Agarwal from Nirmal Bang Securities. Please go ahead.
Thanks a lot for taking my question, sir. My question pertains to the current cash flow crunch, which you have cash burns, as you say. And going forward, when situation is improving, probably it's improving a bit slowly. Plus, we have the capex for next year, which you've said. So is there the possibility that apart from taking money from the banks, which is in form of debt, you could be coming into the market to raise further money to help you support so that net debt to equity at least remains a certain level and the pressure on the cash flow because of interest doesn't become too much?
So, Amit, where we stand today and the lines of credit as well as the potential debt raise that we're looking at, we should not need any more. But we are not averse to maybe raising some capital from the equity markets, but not something that is on the cards as things stand today.
Sure. Thanks a lot, sir.
Thank you. We have next question from the line of Nimish Patil from Escapedia. Please go ahead.
Hi, sorry for another question, but my last question is, when does the company, or in fact the entire hotel industry, expect to return back to quarterly profits?
I wish I was as good a soothsayer to answer that with some 100% confidence. But as I said, I mean, our expectation is that the year FY22-23, we should be in a good space with yields as good as FY20.
Great. Thank you.
And in our case, we've got to keep in mind that in another 1 or 2 years' time, we'll have those 2 new office assets also opening up. And when I say FY22-23, I'm talking about the hospitality part of the business. Add to that the 2 new office buildings that we are commissioning around that time. There should be a significant uptick in our operating numbers.
Great.
So do you have any further questions, Mr. Patil?
Oh, no, that's pretty much it. Thank you so much. I really appreciate it.
Thank you, sir. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Sanjay Sethi for closing comments. Over to you, sir.
Thank you so much. Thank you for taking time off to attend our earnings call. And, whilst we've gone through a difficult patch for the last 2 or 3 quarters, as I said, I think the worst is behind us. We're looking forward with renewed energy for a bright future ahead for the company, the hotel, the industry in general, and the people of the world. May I wish you all a very happy Diwali in advance. Stay well, stay safe. Thank you.
Thank you very much, sir. Ladies and gentlemen, on behalf of Chalet Hotels Limited, that concludes this conference call. Thank you for joining with us, and you may now disconnect your lines.